सन 2002 में एक बड़ा सपना देखा गया। एक ऐसे देश का जो हवा से बातें करे, ऐसे शहरों का जो कभी ना रुके, और एक ऐसी कंपनी का जो इन सपनों को साकार कर पाए। और इसी सोच के साथ राजेश अग्रवाल जी, उमेश अग्रवाल जी और रमेश अग्रवाल जी ने मिलकर रियल ग्रुप की शुरुआत की। इस एक बड़े सपने को हकीकत बनाना ही एकमात्र लक्ष्य बन गया। रायपुर में एक रोलिंग मिल के सेटअप से रियल ग्रुप की नींव रखी गई। सौरभ अग्रवाल जी, गौरव अग्रवाल जी, शशांक अग्रवाल जी, बसंत अग्रवाल जी और शिव अग्रवाल जी के साथ मिलकर धीरे धीरे एक छोटी सी रोलिंग मिल बहुत बड़े फुल्ली इंटीग्रेटेड मैन्युफैक्चरिंग प्लांट में बदल गई। आज रियल ग्रुप रायपुर के सबसे प्रतिष्ठित फैमिली ओन कंग्लोमरेट्स में से एक है। हमारे इंटीग्रेटेड स्टील मैन्युफैक्चरिंग फैसिलिटीज में रियल इस्पात एंड पावर लिमिटेड, शिवालय इस्पात एंड पावर प्राइवेट लिमिटेड, एपीआई इस्पात एंड पावर टेक प्राइवेट लिमिटेड, रियल इस्पात एंड एनर्जी प्राइवेट लिमिटेड जैसे अत्याधुनिक प्लांट्स रियल ग्रुप के पास हैं। इन मैन्युफैक्चरिंग यूनिट्स से स्पंज आयरन, बिलेट्स, टीएमटी बार्स, वायर रॉड्स, एचबी वायर, बाइंडिंग वायर, जीआई वायर, बार्ब्ड वायर का उत्पादन करते हैं, जिसके लिए कैप्टिव पावर और सोलर पावर का जनरेशन किया जाता है। हम प्रति वर्ष तकरीबन 10 लाख टन फिनिश्ड गुड्स मैन्युफैक्चर करते हैं, जो जीके टीएमटी और रियल वायर ब्रांड नेम से मार्केट में अपनी पहचान बना चुके हैं। हाई क्वालिटी जीके टीएमटी और रियल वायर बनाने के लिए हम एनएमडीसी का टीआर सेलो आयरन और इस्तेमाल करते हैं, जो इंडिया का बेस्ट आयरन और है। हम कोल इंडिया लिमिटेड से कोल खरीदने के अलावा ऑस्ट्रेलिया, इंडोनेशिया और साउथ अफ्रीका जैसे देशों से बेमिसाल क्वालिटी का कोल इंपोर्ट करके इस्तेमाल करते हैं। हमारे रोलिंग मिल्स में जर्मनी की एच एन के थर्मेक्स टेक्नोलॉजी के साथ ब्लॉक मिल टेक्नोलॉजी, हॉरिजॉन्टल एंड वर्टिकल मिल, सीमेंस मिल ऑटोमेशन और टंगस्टन कार्बाइड रोल्स जैसी एडवांस्ड और अल्ट्रा मॉडर्न टेक्नोलॉजीज इस्तेमाल की जाती हैं। आज हम गर्व से कह सकते हैं कि जीके टीएमटी और रियल वायर ना सिर्फ देश में बल्कि विदेशों में भी अपना परचम लहरा रहे हैं। सबसे उच्च क्वालिटी प्रोडक्ट्स देने के लिए रियल ग्रुप के रॉ मटेरियल्स और फिनिश्ड गुड्स की स्ट्रेंथ, क्वालिटी, केमिकल, मैकेनिकल और फिजिकल प्रॉपर्टीज की जांच वेल इक्विप्ड अल्ट्रा मॉडर्न एनएपीएल अप्रूव्ड इन हाउस लैब्स में ही की जाती है। आज देश और देशवासियों के भरोसे के कारण ही रियल ग्रुप के प्रोडक्ट्स गवर्नमेंट ऑफ इंडिया के प्रोजेक्ट्स के साथ प्राइवेट सेक्टर के लार्ज स्केल डेवलपमेंट प्रोजेक्ट्स में भी इस्तेमाल किए जाते हैं। हमारे सारे प्रोडक्ट्स भारत में इस्तेमाल होने के अलावा यूरोप, वियतनाम, नेपाल, थाईलैंड, अफ्रीका और श्रीलंका जैसे अन्य देशों में भी एक्सपोर्ट किए जाते हैं, और इस बात का हमें बहुत गर्व है। हाई क्वालिटी आउटपुट देने के साथ हम पर्यावरण का भी उतना ही ध्यान रखते हैं। हमारे सारे मैन्युफैक्चरिंग यूनिट्स के लिए हमने एक एनवायरनमेंट फ्रेंडली ग्रीन ट्राइब्यूनल बनाया है, और पर्यावरण की सही तरीके से रक्षा करने के लिए यूनाइटेड नेशंस ने रियल ग्रुप को मॉडर्न प्लांट भी घोषित किया है। रियल ग्रुप की सस्टेनेबिलिटी और एनवायरनमेंट फ्रेंडली जीके टीएमटी के ग्रीन प्रो टीएमटी के द्वारा हम कार्बन एमिशंस कम रखने का वादा करते हैं, जिसकी वजह से हमें ग्रीन प्रो सर्टिफिकेशन और स्टार रेटिंग्स भी प्राप्त हुई है। हमारे फैमिली ऑफिस रियल एंड सन्स के जरिए हम अपकमिंग स्टार्टअप्स, बिजनेसेस, स्टॉक मार्केट्स एंड इक्विटीज में इन्वेस्ट करते हैं। इसके अलावा हमारे रियल एस्टेट वेंचर रियल स्पेसेस के हाउसिंग और अन्य रेजिडेंशियल प्रोजेक्ट्स जैसे वेदा 42, अनंता, द ओल्टेयर और वानिया के जरिए रायपुर में पहले से ज्यादा प्रोग्रेस और डेवलपमेंट देखने मिल रही है। बिजनेस वेंचर्स में अपना परचम लहराने के अलावा रियल ग्रुप के द्वारा समाज के सुधार की तरफ प्रयास करते हुए रियल केयर फाउंडेशन की स्थापना की गई। इस फाउंडेशन के तहत रियल स्किल एकेडमी, जिसमें 12 गांव के लोगों को हर वर्ष उनके स्किल डेवलप कर उन्हें रोजगार दिलाने का प्रयास करते हैं। इसके अलावा वृंदावन हॉल एंड ऑडिटोरियम और चितवन वृद्धाश्रम के जरिए हम समाज में प्यार और अपनेपन की भावना बरकरार रखने की कोशिश करते हैं। हम अब और भी बड़े सपने देख रहे हैं, जहां हमारी कोशिश है कि सबके पास अपना घर हो और उसकी नींव हम रखें। भारत को शानदार स्ट्रेंथ और बेमिसाल फ्लेक्सिबिलिटी देते हुए रियल ग्रुप देशवासियों को बस ये कहना चाहते हैं कि अपने सपनों को जी के देखो। जी के टीएमटी, सपनों को जी के देखो।
Rudra sir, good evening.
Good evening,
Sir,
Amit ji.
can you start, sir?
Yeah.
Rudra sir, are you there?
Hi everyone. Hi, I'm here.
Yes, sir.
Hi Amit.
Amit,
Hi
can
Keshav.
you
Yes,
a
sir.
bit louder? Your
Hi
voice
Sudesh.
is, I guess, coming very, very low.
Okay. Now is it okay, sir? So,
Yeah.
let me start, sir. Good evening, ladies and gentlemen. Very warm welcome. All of you. I'm Amit Kumar Soni, co-founder of Steel Trade Info Services, and it's my privilege to be your host today for this session. So, it's my pleasure to welcome you all in this insightful decision on long steel and construction, steel market outlook, opportunities, challenges, and market evolution. The long steel and construction steel segment continues to play a vital role in India's infrastructure and economic growth. With increasing investment in housing, transportation, and industrial development, the sector is witnessing new opportunities alongside evolving market dynamics and challenges today. So today's discussion will explore the future outlook of the long steel market, emerging trend, industry challenges, and the opportunities that lie ahead. So we are honored to have with us our distinguished speaker, Mr. Keshav Beriwala, Director Sam Steel Limited, brings extensive experience and deep industry insight into the sector, especially in the long run. So joining him as the session moderator is Mr. Rudra Khan, who is practice head Quest Group, who will lead the today's engaging discussion through provoking questions and expert insight. So before we begin, I would like to extend our heartful gratitude to our esteemed speakers and our delegates for their valuable support in making this event a success. So, ladies and gentlemen, thank you once again for joining us. We hope you find today's discussion insightful and valuable. Without further delay, I now have the pleasure of to invite Mr. Rudra Khan to take over the session and begin this engaging conversation. Sir, Rudra sir, so the stage is yours. Thank you and wish everyone an insightful and engaging session.
Thank you so much. And very warm welcome to Keshav ji as well as all the participants here. Looking forward to an engaging discussion. Before we begin our fireside chat, Mr. Keshav, I'd like to just present a few slides that I've prepared to base our conversation in some data. Allow me a minute to just share my screen. Please let me know when my screen is up.
Yeah, it's visible now.
Great. All right. So, to everyone present, the 9% number is I want to base the discussion in this that India's steel demand growth is at a very robust 9%. It's actually one of the strongest in the world. It is being said that our steel growth and our steel demand is one of the strongest in the world at this minute. But at the same time, our manufacturers, especially our secondary manufacturers, are facing tremendous pressure on the margins. And this has evolved over the last 5 years. The EBITDA per ton for our manufacturers has been shrinking. So what is this dichotomy? Why is it that while the top line number is growing so robustly, the pressure on the margins keeps going up? If we discuss on the demand, we know that the demand on the overall steel is very robust and it's structural. It's not cyclical, and therefore it is a long-term growth that we are looking at. So the WSA and ICRA together would say the demand is almost double digit. 9 to 10% is the growth projection for the next year on steel, and it is supposed to continue till 27 as well. And our long products portfolio sits bang in the middle of it at around 63% of this 150 million tons of demand that we are currently seeing comes from our wire rod, structural steel, TMT. And of course, why should it not be so? Because our core infrastructure uh, spend that is needed till 2030 to become a $7 trillion economy is upwards of $2 trillion just in core infrastructure, right? This will be done in spends in logistics, in transport, in infrastructure buildup, our roads, bridges, railways, in all those kind of segments, right? Then coming to what are the drivers which are going to take this demand to this kind of quantum. In our current budget, we have PM Gati Shakti, which is already active in ports, logistics, rails, roads. This demand is already in place, and it's coming. Over the next couple of years, we know that the PMAY Urban 2.0 is coming in, which again will give a push on the housing front. And then Bharatmala Phase 2 will kick in, which will bring estimated 30 million tons of incremental annual demand. So all this put together, we are the 300 million capacity target seems legitimately needed when we put all these together. So our per capita target also has to go from today's 100 kg to 160. We have said that it was very low for a long time, 60 to 70 kgs. It has come up to 100, but now we need it to go up to 160 kgs. So herein, I want to discuss three forces in through our conversation. The first force that I believe is creating that margin pressure that we spoke about earlier is because of the global overcapacity. We know that globally we are sitting at an overcapacity today, and it's only going to increase by 2027. That overcapacity number will go shoot up to 700 million tons. So note that by that time we will be reaching around 200 million tons in capacity. I'm talking about pan India. So this 700 still is almost 3.5x of our overall capacity. And if I contrast that with what is India's demand growth that will take place over that time period, let's say 2020, FY25 to FY30, that's only 34 million tons that is projected. Whereas if I look at Asia plus Middle East steel capacity additions, that is upwards of 100 million tons. So that gap itself is projecting into the margin pressure that we are already seeing. And of course, all this, the biggest participant in the steel market, China, is also seeing a decline in their domestic demand. So their overcapacity is also to go somewhere. And in April 2026, for an example, we saw that imports doubled in a single month. So despite the duties that are in place, the protectionist measures in place, we are still seeing that due to the deluge of material in the market, that overcapacity is causing a pressure on the prices and therefore margins. The second force that I want to speak about is the difference in the rate of increase of our demand that is projected versus the capacity that is getting pulled in. So today there is a 50 million tons of deficit in demand versus the crude steel capacity. But if you see going forward, the projected capacity goes up much faster. So by FY30, it is projected that we will go up to 300 million tons as a target. And Vision 2047 talks about a 500 million ton capacity of crude steel. Will domestic demand keep pace? That again is a big question to ask. Finally, the decarbonization clock. So we know that steel industry is one of the highest emitters of carbon dioxide. 2.65 uh, tons of carbon dioxide is produced per ton of steel. And this is 20% above the global average. So while there are some good measures that are coming in, we know that 94 producers have been issued green steel certificates across 15 states as of May 2026. So this is a great initiative, but at the same time, 7 to 9% of global CO2 emissions come from steel. So we are steel industry is one of the top three, the others being chemical and cement industries. And this is the reason that cement and apart from cement and chemicals, steel has to be the industry which comes up with its own norms and quickly evolves in this particular area. And one welcome initiative that has been proposed is that by FY28, uh, through the Green Steel public procurement mandate, all government buyers have to mandatorily buy a proportion of green steel. Again, this is still in a proposal state, but a lot of push from CII, from the Ministry of Steel, has come in this direction, which is a welcome move. But if I talk about the transition pathways, so clearly scrap-based EAF and renewables is the immediate solution, which is already making sense in terms of cost. So while it's scalable, inside this long product, specifically rebar is a lead product because it can consume a lot of the scrap based raw materials, but flat products, because again the consumption of scrap there is lower, therefore the adoption may be lower. So the reduction in emissions is up to 88% through this route. If I talk about hydrogen-based DRI and EF, this together will give the biggest reduction, 90 to 97% reduction. But because of the green hydrogen costs, which need to be below $2 a kg, for us it looks like it will go beyond 2030 for this levels to be reached. But while some companies are proceeding in this direction, long term adoption or industry wide adoption still seems far. And if I talk about BF reducing their carbon emissions, CCUS is the path to go for existing BF. So here again, the capex is still prohibitive. It seems that it's still early stage for India. So having said all this, I want to discuss these three forces with Mr. Keshav Beriwala. Very welcome, Keshavji. These are the three forces that I want to discuss with you. Sham Steel, as you all know, has been producing steel in our country since 1953. And of course, now with a lot of new investments, they are expanding within and beyond West Bengal. So, very warm welcome, Keshavji. I hope the points I mentioned in my presentation were well received. Let me know your comments on the presentation.
Yeah, thank you, Rudrik ji. Thank you, Amit ji and Kshitij ji also for hosting this session. Rudrik ji, I think the presentation that you showed pretty much sums up the situation very nicely. We can probably discuss each of the points that you mentioned one by one. So the first point that you mentioned regarding the overcapacity being a ceiling, I think you were right, because even though we look at the fact that there has been 9% annual growth in the steel demand in India, we should look at the steel capacity numbers, and those numbers are beyond 11 to 12%. So the moment your incremental change in capacity is higher than your incremental change in demand, that's when your margins take a hit. So that's what's happening in India over the last 5 years. If we compare the EBITDA profile of any steel industry 5 years back to now, this is the main thing that we'll see, that the top line is growing because there's good demand, there is good lifting of the end product, but at the same time the operating margins are decreasing, and so you'll see that the EBITDA is primarily around the same level that it used to be at, let's say even half the revenue levels. One structural change that is happening in the long product market. So we need to realize the evolution of the long product industry in India. Earlier, the long product market was primarily a downstream market where the primary players used to make the semis. So your Tatas and Jindals would make the semis, and then the semis would go to these small downstream industries which would make the long products. That is how the market was originally shaped. Over the years, what's happened is that both the primary players have forward integrated into the downstream products, as well as the small downstream units, they've been backward integrating. So earlier, and this has in fact been our story as well. So we started off as a downstream unit. We just had the downstream product. We had our TMT bars. Then we installed the steel melt shops where we made the billets. Then we further backward integrated into the sponge iron and the power plant. So this is largely the tectonic shift that has been happening in the industry over the last few decades, and it has more so accelerated in the past 5 to 10 years, where the downstream units, if you were just a rolling mill, today you cannot survive in the market just being a rolling mill. The economics just don't work in your favor. The scales doesn't work. Your overheads, your transportation costs will just kill you. So 5 years ago, if there was just a rolling mill in the market, what's happened over the last 5 years is that they've probably come up with their own steel melt shop. So they're making their own billets. If there was a company that was just a steel melt shop and a rolling mill, they further backward integrated. So they now have their own sponge iron unit, they have their own power plant. So this is a change that the industry is seeing, and it is just going to get more and more so that you can't survive just being a semis creator or a semis absorber. Today, if a new player comes into the market and they want to be, let's say, in the TMT bar market or the wire rod market, they can't just be focused on one unit. They have to think along the integration. So you need to have your power plants, you need to have your sponge iron, because that's when the real savings start to kick in. And that is what essentially helps you glide through the downturns in the economic cycle of steel, where even if the margins are taking a hit, you know that your cost structures will help you survive. And that is why we see that even though the steel demand is growing, the capacities are growing more than that. And because it's integrated capacity, which is why the producers are able to absorb that shock in the margin. And you'll see all the players complaining about the margins continuously, but all of them are expanding further and further. Uh, I think this is going to be the new normal. We can't expect COVID levels of margins again because that was a structural shortage in the market. So, as a 70-year-old industry, we are also, very bullish on India's long-term story. We're continuously investing, but we don't expect the margins to be like the COVID level margins anymore. You need to have your integrations in place. You need to run your operations. You need to run a tight ship. You need to control your cost, and only then you can survive in the market. Today, you can't just be a rolling mill, or you can't just have a steel melt shop where you buy sponge iron and you make billets and you sell billets. Your purchasing is also limited, and your sales will also be limited. 5 to 10 years
Wow.
ago, you could have had a plant that was just, let's say, selling billets. Today, you just won't have a big enough market. You won't have a lot of rolling mills that are just buying billets, because those who were just buying billets, they have their own steel melt shops now. So that is the
That's a
change that the
great
industry
point.
is.
Yeah, Mr. Kish, that is fabulous. I completely respect that. Having navigated multiple cycles over the last 70 years, you have a visibility on how structurally the industry seems to be moving. But if I can also get your viewpoint on, let's say this, we were discussing how the industry has transitioned over, let's say, last 5, 10 years. Do you see this going into the next 5 years? This will this continue while sham steel has reached a particular scale? Will smaller producers also be able to do this kind of a forward backward integration, or they will have to look into some other strategies as well?
Yeah, so this is a natural shift that happens in this industry. It will continue to happen because if there were smaller players, there's only two options. Either they became consolidated and they have their own backward integration setup now, or they just exited the market. So that's the only two possibilities. You can't keep running in this industry just being a small player or just being a single unit. So that shift has been taking place, and it is going to get further accelerated with more and more integration. So regardless of your company as a individual entity, if the market is moving towards more integration, that itself is structurally unfavorable towards a single entity if they don't have the integration in place. So that is the shift that I see going ahead in the market, where you'll have more and more consolidation at the individual company level. You'll have bigger units, and the smaller units will either have to turn into the bigger units if they have the cash flows supporting them, or they will be eventually exiting the market.
Interesting. Yes. Moving gears, shifting gears, Shyam Steel has been announcing quite a few expansions, not only in West Bengal but also Maharashtra. Also I've seen your Middle East expansion coming. These are not small bets. So they are being made in an environment where, as we discussed, like global overcapacity is quite high. Chinese exports are flooding. So all put together, Shyam Steel is still putting in these bets. So this reflects a specific viewpoint that you seem to have. So when you are committing this kind of capital in the environment, what does your demand visibility actually look like, and how much of this confidence is coming from domestic infrastructure pipelines versus the opportunity in export markets?
See, if we look at the steel business that we have, it's primarily a domestic market that we are catering to because we're in the long products market. India's long products market is essentially insulated from global movements, both in terms of import and export. So today, when we talk about China's imports into India, that doesn't directly affect our long products market. Maybe indirectly, you could say that more flat steel is coming into the country, and so the flat steel producers could be little, pushing more towards long steel. That might be one of the reasons. But directly, India does not import a lot of long steel. So long steel is essentially a domestic market catered to by the domestic players. So when we are, in talks with Maharashtra and let's say a state like Odisha, essentially what's happening is that till now our company was just focused on West Bengal. And over the last 10 years, we've started supplying beyond West Bengal as well. So today we have a pan-India distributor and a dealer network through which we are catering to the needs of the market. And we've been able to position ourselves as a brand that is, consistently supplying quality material. So one challenge that we face is that, being a producer just in East India or just in West Bengal, it's tough to cater to markets in, let's say, West India or South India. And we see that structurally, India's demand is going to go up no matter how much the supply goes up. At the end of the day, the most efficient manufacturer is going to win. And that is a bet that, legacy companies like ours can take, where that we run the company and the operations efficiently. And regardless of what the supply would look like, whoever remains in the market has to be the most efficient. So being that and having a brand that allows us to, reach out to the customer and be able to explain that the kind of material that we are providing is of higher quality and superior quality, and we can do that sustainably, we are very bullish on the market. And so as an idea, we want to reach out to more and more states to be able to cater to their demands. And for that, we require to have setups in those areas so that our logistics can be favorable for us.
Got
And of course,
so
just one more point, as you
yeah,
mentioned, India's per capita steel consumption is still around 100 kgs, which is less than half of the global averages. I think global averages today is around 220 kgs, if I'm not wrong.
yeah,
And so there's massive headspace for growth. I mean, even looking at today's per capita consumption, we could easily say that it should be double of what it is. So we see that the next 10 years should have a lot of growth in the market. And whoever is able to reach out to the customer in the lowest cost essentially wins. And so that is the reason why you would need setups in various locations if you're catering to the retail market.
absolutely. Great answer. There's one aspect that I would want you to elaborate on. While you spoke a lot on the domestic requirement, domestic demand, are you also looking at exports? Are you also looking at certain?
Yeah, so we're not looking at exports in the steel market. We have exposure in the ferroalloys industry where we make ferroalloys and export that. So that is essentially the only market that we are exporting in. And as you mentioned, we've recently now expanded to the Middle East as well, but that is again non-ferrous metals. So when we look at steel, we aren't looking at the exports market as of now, and especially because we're not in the flat products market. So our primary focus is to cater to the domestic market because we see massive head growth here. So because one would start to think about exports in this market if there were no space for your domestic consumption. But today there's so much demand. The only issue is that it's cyclical. So when you look at the monsoon months, so right now, let's say the demand has started slowing down, so you'll see the prices going down. Probably post monsoon, post Diwali, this will pick up again. So you need that kind of flexible cash flow where you can survive the downturns. But anyone who's in it for the long run, we see a lot of room for growth. You go to any state in India, you go to tier two, tier three cities, you go to tier four cities, you can see, what the room for growth is. If you go to a country like China and you compare, you'll see that, we are just at the tip of the iceberg. There's a lot to be done yet.
Absolutely. So while we spoke a lot on the positives of the industry, the demand is very robust, and there's an overall need for companies to expand. There are some challenges to the industry as well. So I would like to tackle that next. The expansion story is not just for Sham Steel. Across long products, there are large integrated players who are and other smaller regional players who are adding capacities, right? SAIL is expanding, JSW is building, secondary producers across East and Central India are adding rolling capacities. So everyone is going after the demand story, but the structural conditions that are present in the pricing ceiling, that your global overcapacity, the rising input costs, utilization pressures, all that would, I would believe, push you to be profitable at the same time while you are expanding. So Given the scale of expansion happening across the long steel market, what are the structural challenges that the industry is walking into? And is there a risk that the sector collectively is building more capacity than it can actually monetize?
Yeah, so you're right. It's not all hunky-dory. There are a couple of structurally inherent challenges that India's steel industry has to face and overcome if we have to think about, let's say, 500 million tons by 2047 or 300 million tons. The first primary challenge that we have is the raw material challenge. So, on average, for 1 ton of steel that you make, you require around 1.8 ton of iron ore and a ton of coal. So you need 3 tons of material for essentially to build 1 ton of final product. So that means a lot of movements. You need 3 tons moving into your plant and 1 ton moving out of your plant. So today, India does not have the logistical infrastructure or the backbone to support this kind of capacity. We don't have enough railway network. We don't have enough railway sidings. We don't have enough wagons to be able to support this. Trucking is not a long-term solution. It's not fuel efficient. It's not cost efficient, and it doesn't support a lot of volume. You can't have hundreds and thousands of trucks coming into your plant for movement of heavy material. So having more railway and having a much more robust logistical network is the need of the hour. In the auctions of Coal India and in the auctions of, let's say, miners like OMC, what we often face is that we'll get the indent, but we don't have the wagon loading being done on time because there's just not enough wagons or not enough traffic that can be moved along the railway lines. So logistics is a very big challenge that has to be solved for if the government wants the country to have 500 million tons capacity in the next few decades. The second challenge, of course, is the raw material availability in itself. Structurally, the India has been iron ore short over the last few years. The capacities which we are coming up with are not being easily met by the enhancement in the mining that is being done. So that is a big challenge that we have. So if you look at lumps which are required in the DRI process, or if you look at iron ore fines which are required in if you have a pellet plant or if you have a blast furnace with a sinter unit, there is a structural shortage in both, which just hits the margins. Because you have more and more companies and more capacities just auctioning for the same amount of raw material. So that essentially increases your raw material cost while the end product price is determined by the market. So your end product price stays the same, but the raw material costs go up, which is again one of the reasons why you're seeing the margin hits, because the raw material is not increasing at the same pace as the end product is increasing. So the need of the hour is that the PSU owned mines, they need to increase their production. They need to modernize their production capacities so that they can increase the supply of ore. And the other problem is that there are a lot of mines that are not operational. So there's two reasons for that. One is that they are just not explored in the first place. And the second is that they've been auctioned off, and the premiums at which they were auctioned were so ridiculously high that it's just not possible for any company to run them at a viable level in a continuous manner. So the government has to come up with some sort of auctioning mechanism where it ensures that once it auctions off a block, that block comes into production in the next 2 to 3 years. Because right now what's happening is that a company would take a block in auction, and then because the premium that they've bid is just so high, they eventually don't end up producing the ore. So that is again an issue that we are facing. But now the government is, focused on increasing the ore production. So you see states like Odisha, you see states like Maharashtra, where there were some underlying social issues in the mines areas. There were some nationalism related issues which the government is focusing on clearing, so that we can have that extra material coming into the market to facilitate more and more production by the steel producers. So one is the logistics availability, two is the raw material availability, three is that you need the infrastructure for the industry to grow. So today, if you want to set up a 1 million ton steel plant, you'll easily require 500 acres of land. You'll require a railway siding near the land so that you can get the railway line into your plant. You'll require a 220 or a 440 kV line or a substation nearby so that you can have the line in your plant. You'll require running water throughout the year. These are issues that are not easy to solve. So today, we've been in the market for a long time to get a piece of land in other states, but it's a very tough process. So that is something that each government, each state government, or the central government has to focus, where the process for getting a new land for a steel plant becomes very easy for an industry. From personal experience, it's tougher to find a suitable land than to set up the steel plant. So that is the irony in the market today, where just getting your infrastructure right is the biggest challenge. If you have the infrastructure, you have the intent of the industry, they are willing to expand, they are willing to put in the capital, but we need the infrastructure. So that is a big challenge for the industry. If the government can solve for it using some sort of policy framework, that will help us accelerate the production in the market.
Fabulous answer and very insightful. Thank you for that. Keshavji, I would like to go a bit deeper into the raw material challenge that you threw up. So, while the challenge that you have addressed on the iron ore side, the, could you also expand on how companies are today addressing that risk? It's a very big risk when such kind of capacities are being put up, and they don't have clear visibility on raw material availability. How are they mitigating this kind of risk? Are there any imports that you're looking at, or any specific kind of mechanism you worked on this?
See, imports today, as of today, are not viable. We have heard, companies in Brazil and some other countries potentially exploring exporting to India, and maybe some companies have got some quantities, but the price points at which we are seeing them coming into the market is just not viable for a steel producer. So we're seeing at least a $200 to $300 delta in the price, which essentially erodes your whole margin. So as of today, imports is not a viable solution. But steel players are expanding. The bigger players are securing a mine to get their raw material secured, which is why we are seeing that in auctions, the premiums are going to ridiculous levels. Essentially, what they are saying is, I am willing to bear losses in this mine just so that my plants could keep running. That is what is happening. So the players who are so huge, where they cannot afford to not have that raw material visibility, they are essentially taking mines at any cost. Sometimes they do end up running the mines, sometimes they end up not running the mines. The other players are essentially banking on the fact that there will be enough iron ore in the future because of the initiatives being taken by the government. Or essentially, what will happen is that the domestic prices will end up matching the imported prices, where there will be a parity, and so then you could import. Today, if there's only so much raw material in India and that doesn't go up, the prices will go up. And
Right.
at some point, they will match the import prices. So at that point, you could just keep importing, and then the price of steel goes up because the raw material cost goes up across the board for everyone. So that is a reality that we could be facing, where the end product price goes up if the raw material supply doesn't accelerate.
Absolutely, fair point. So finally, I would like to touch upon the third force that I mentioned, Keshavji, during my presentation. That's on the decarbonization front, right? India's steel industry emits, as we discussed, 2.65 tons of CO2 per ton of steel. So as you mentioned, it's quite high compared to the global average. And now we know that the EU CBAM is in place. Your steel certifications are being issued. Then we also discussed the green steel public procurement policy, which is proposed, right? So all these pressures from multiple directions are hopefully this will push for a more green future for us, a more green steel futures where, let's say, scrap based EAF is probably the near term pathway. For flat steel, it could be a BF, BOF kind of operations. So all put together to ask you, is there any real pressure on the steel industry to decarbonize? If so, is that pressure landing harder on long products today, or equally on long and flat products? And also, how is the industry actually taking up the challenge? Are there inherent obstacles in India's path to a green steel future?
So see, today, if you look at the long product market, there is no export pressure in terms of green steel because India doesn't export a lot of long products. There has been some pressure already in the ferroalloys market because India is a big exporter to Europe. And so CBAM coming into picture has been a bit of a pressure on that side. And potentially flat products is also an area where, global awareness regarding CO2 will be a pressure on the flat products market. That has not happened yet with long products, but we have domestic awareness also now in place. The government has come up with its own CCTS mechanism where industries have been given a target. we have this thought now that we have to decarbonize. Whether it's a 2-year process or a 5-year process or a 10-year process is to be seen, but we have to decarbonize. Now, there are some inherent challenges in the industry if we are to decarbonize. As you rightly mentioned in your deck, the scrap along with renewables is the lowest hanging fruit. But there is a big challenge in that market where you don't have a reliable and consistent supply of compliant scrap. What I mean by that is that scrap in India is a very informal and a fragmented market. So if you buy scrap, regardless of the fact that you have followed all the compliance on your end, you have paid in check, you have the evidence of the product, everything, maybe somewhere in the supply chain, some trader did not file the GST for that product. So the liability essentially comes to the industry where the government will come knocking on your door asking for a supply explanation. And so it's a big hassle where you keep explaining, you keep, fighting legal battles just because you wanted to buy scrap from the market. So that is a very big challenge where there has to be some sort of mechanism or platform or market in India where industries are not fearful of buying scrap. So we ourselves should be very fearful of buying scrap because we don't know what kind of scrap is reaching us. We don't know the compliance of the whole supply chain. What will end up happening tomorrow, we don't know. So we need basically a regulated market where industries can buy consistent and large quantities of scrap. That is a very big challenge. Or if the government can come up with a RCM mechanism, where the reverse charge mechanism, where we buy scrap and we directly pay the GST to the government. So we essentially don't depend on the middlemen filing the GST. We just pay the GST to the government, and we can ensure that our scrap we have paid the GST for it. So some solution needs to come up in the scrap market where it has to be a little more formalized because as we grow this demand for green steel, scrap is going to be the need for scrap is just going to increase. And till now India has been importing a lot of scrap. But one change that we are seeing in the market is that all the countries are now more and more aware of the fact that scrap is the lowest hanging fruit in their decarbonization journey as well. So we might start seeing countries not exporting scrap very easily. So that will become a very big challenge for India, where today we are importing, or if we just don't have a lot of supply, or if we have a lot of duties when we want to import scrap, then the costs are going to go up. So we need to be self-reliant in this matter, and we need to have our own formalized scrap chains. The other problem is that when you look at the renewable market, you need parity across the states. Today, a state like Chhattisgarh is allowing open access. It's allowing banking of green units, and a state like West Bengal is not. So that incentivizes a player in Chhattisgarh to put up a solar plant, but it does not incentivize a player in West Bengal. So we need parity across the policy network, where all the industry players have access to the same rules. So they have access to the same incentives, and they can, start their decarbonization journey. Today, if we set up a 100 megawatt plant, solar plant in West Bengal, and let's say during the day we have some excess solar units, we don't know what to do with it. We can't just give it to the grid and take it back from the grid later if we want to. So that is a big disincentive for us when it comes to, setting up more green energy. Second is that, as we all know, the grid has been strained in the past few years because of the rise in solar power. So we'll see a lot of surge in generation during the daytime, which the grid cannot absorb. So we have to have some sort of battery network in place, which is just not viable today. So maybe we can have some sort of policy intervention where the government can subsidize the battery storage part at least, so that the industries are incentivized that when we are putting up solar plants, we can also put up some sort of battery storage. So that can be a very good combination where you can have legally compliant scrap available to you consistently, and you can have renewable energy along with some sort of battery storage which the government can incentivize. So that takes care of your low hanging fruit. Now, when we talk about bigger challenges, we have been seeing a lot of mention of green hydrogen so that we can have hydrogen and DRI. Or we are seeing recently, we started seeing talk of coal gasification. All of these are not simple or easy structural changes in the industry. They are very high capital intensive. As of now, you don't know what you'll end up making the costs, the processes. It's a very nascent stage. So either the government has to come up with a framework where it incentivizes a few first movers so that these first movers can come up and they can experiment. Essentially, this is risk capital. This is not business capital. Today, if we are expanding our business, we know that every 100 rupees invested, what is the nature of our return profile on that? But if we are to invest into a green hydrogen based DRI plant, that is not business capital, that is risk. The whole capital is at risk. You don't know what the working economics are. So either the government incentivizes that, or the government somehow comes up with its own infrastructure hubs. So, let's say a hub where industries can get access to green hydrogen. So we don't have to invest in green hydrogen, but we can get access to it. So we can somehow use the green hydrogen through some sort of pipeline, and then we can have our own production processes which depend on green hydrogen. So I see that something has to be done. Either the government comes up with the incentives, or the government comes up with the infrastructure where it is able to give you the green hydrogen that you need in order to decarbonize. And the third that I think that your deck mentioned was the carbon capture and utilization, which is essentially just a cost center. You have a lot of these technology startups coming up where they're saying that we'll capture the carbon and we'll turn it into some product, we'll turn it into graphite, or we'll turn it into soap or something, but the economics are not still not very favorable on those. So end of the day, what ends up happening is that the capex just goes up. So either the government mandates it that if you want to have blast furnace, you need to have carbon capture, in which case the capex goes up, and in which case the end product price will go up. So we need to be able to absorb that price. As you mentioned, the government has come up with its own mandate where you have to buy green steel. So either you give some sort of premium on the green steel that the government is purchasing. So that again incentivizes the industry to put up these expensive technologies in place where we turn the production green. But we can realize that in the end product as well. So there is intent in the industry, but intent is not enough because this is an infrastructural problem. Any infrastructural problem requires at least a 5 to 10 year time frame within which that can happen. Today, if we decide we want to become green hydrogen, it won't happen overnight. It will require at least a decade before you have the supply chain in place, you have the logistics in place, you have the local intelligence in the ecosystem. So because this is an infrastructure problem, it has to be met with either policy framework, or it has to be met with the government supplying that, or it has to be met with incentives. So that is the challenge with the high hanging fruits, so to say. The low hanging fruits are again scrap and renewables, which can be easily taken care of with just more supply of scrap and with parity in the renewable market.
Thank you, Mr. Keshav. Very well-rounded answer. I think it covers most of the questions that I thought that I'll ask you as a follow-up on this as well. It covered feedstock, energy, technology, policy parameters as well. One point that you mentioned very interestingly, I want to double-click on. That is the cost versus premium gap. Is the green steel premium something that you believe that customers in India will want to pay at, let's say, not today, but once it becomes a natural thing? Let's say we discuss the mandate for government buyers to pay that extra premium for green steel. Do you think that will catch up with the rest of the market, or it's already in place, do you think?
I don't think anything as such is already in place. The only question is whether it can be in place in the future. So personally, I don't see India's retail market paying for any green steel premium, because that's just how we are as a market, as an economy, where the market is very price sensitive today. And you see this in any industry. You pick up, you see the FMCG industry, you essentially see any consumer industry. It's a very price sensitive market. Indians don't like to pay extra. That's the brutal reality. The only situation where this could happen is if it comes from government or the institutions. If the government in its own projects mandates a green steel and mandates a green steel premium, that can be a big market for green steel in India, where companies will be willing to spend extra money so that they can premiumize and so that they can sell their green steel. Or if the government mandates institutions who end up using steel, that you have to use X percentage of green steel in your processes. That can be a market where you might see more and more companies buying green steel, and the companies might be willing to pay because maybe the companies are mandated by the government. So these are the only two situations I see. Either the government mandates their own projects to be using green steel where they pay for the premium, or the government mandates users of steel. But I don't see the retail market paying for a green steel premium.
Not now, not anytime in the future.
I mean, not now. Maybe maybe in the future, if there's so much awareness and so much consciousness in the Indian consumer that we want green steel. But I think that's way ahead in the future. Right now, we're in the process where, people, not everyone even has a house. So getting the right infrastructure in place is the first challenge, let alone, the infrastructure being green.
Fair,
So
fair point.
I don't see
So,
the India's
so
retail market turning green
fair,
unless
fair,
the
Keshav.
government mandates the producers.
Got it. So finally, if you have any call to action, let's say for your investors, steel manufacturers, or also maybe let's say policy makers, or let's say the overall industry also, to progress on the green steel mandate, what would your call to action points be? Let's say if they're listening, on this call.
See, my call to action will be that any new sort of technology that we want to inculcate in the market, be it coal gasification or be it green hydrogen, the first step has to come from government, because these are not explored markets and these are cost markets. It's not a profitable venture to just, invest in coal gasification or invest in green hydrogen, because the costs just don't make sense. So if we want to take a first step, that first step has to come from policy or from the government. Second, the call to action can, and the government is already working on it. So we have the coal gasification scheme now, where I think the government has allocated 37,000 crores or something, where it will incentivize industries to put up coal gasification. So that is happening. My second call to action will be to incentivize battery storage, because battery storage is the biggest hindrance to higher adoption of solar power, higher adoption of wind power. If we can have more battery storage, then we can, eventually just think of, uh, uh, reducing the use of coal in power plants. And the third has to be that, nuclear power seems to be a very good solution. So the government has to move towards privatization of the nuclear power ecosystem, where more and more companies can come into the market, set up nuclear power plants, because the nuclear plants essentially don't rely on any imported fuel, and nuclear plants would be running 24/7. So the consistency would be there, which could be equivalent to the consistency of a thermal power plant without the same level of pollution. So that again would be a potential call to action, where we can have our private nuclear ecosystem in place. And finally, another call to action can be India's coal is very inferior quality coal. So if you compare it to any other country's coal, we are importing a lot of coal. India's coal has a lot of high ash content, and the carbon content and the GCV content is very low. So we need more and more coal washeries in place, so that we don't end up wasting transportation fuel and transportation money on transporting ash to our plants. So let's say Coal India today is almost the majority seller of coal in India. If we can have more and more washeries at the mine pits, that would be a big step in sustainability as well as cost sustainability, where the coal is being washed at the mine, and we just get cleaner coal into the plants, and we're not wasting energy and resources on transporting ash.
Fabulous answers. I really enjoyed speaking with you, Mr. Keshav. Thank you. Thank you for this.
Very, very, very
Kshitij,
insightful question and insightful discussion. Thank you so much.
thank you. Okay, Kshitij, if you want to come in.
Sir, just one question. I think one of our attendee has been asking this question a couple of times. So it was more suitable for this particular session, that's why I would like to take up just one question, sir. Is fiber rebar better than the steel? This is what we have been getting a lot of. I mean, couple of attendees have been asking this question.
We have also done some research. We've not invested yet in any fiber rebar till now. We've been exploring it. We've also heard it multiple times, FRP bars. But we don't see it replacing steel, because we don't think that it has the same strength profile of steel. So we don't see that, FRP bars can be a replacement for TMT bars, but maybe it can have its own small market where it's catering to niche demand. But we don't see that, at a big scale, fiber can be a replacement for steel.
That's very well answered the question, sir. Once again, sir, before winding up the session, wanted to personally thank you. I understand yet that your schedule has been busy, and you have to take out time specifically so late in the evening to join this session. But then we are really honored to have you, and we'll definitely be looking forward for more such association with you in the times to come. We will be coming up with the Dubai event soon, and we'll reach out to you once again.
Thank you so much, Kshitij. And as you correctly mentioned, there's been some last minute travel changes in my
No, no
plans. So
problem.
thank you for accommodating also.
No,
And
no problem. It is
at the
pleasure
last
is
moment,
ours, sir.
your
Pleasure
team was
is ours.
also very, very supportive. And this was a very insightful discussion. So thank you very much.
Thanks a lot, sir.
Thank you.
Thank you, sir.